This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Growth track Wal-Mart making a big prediction about its future, and many of its retail rivals fight to hold on to sales.
Soap opera Procter & Gamble declares victory in a contentious boardroom battle, but the activist investor says not so fast.
And up in flames, vineyards and wineries destroyed as wildfires rage through California's precious wine country. Those stories and more tonight on Nightly Business Report for Tuesday, October 10th.
Good evening, everyone, and welcome. The Dow closed at a record thanks to a big move higher by Wal-Mart, and that's where we begin tonight. Wal-Mart wants to cement its title as the world's largest retailer. The company is forecasting huge growth in its online sales, and it predicts it will happen in just a few years' time. At its annual Investor Day, the big box retailer outlined plans to invest a lot of money in its digital operations, a move that pits Walmart directly against Amazon in the race to win shopper dollars. That, along with a $20 billion share buyback, sent shares up about 4.5% in heavy volume to a 2-year high. Courtney Reagan takes a look at Walmart's big plans for the future.
Walmart is making a prediction you rarely hear in retail. It's forecasting growth for earnings and sales, including 40% online sales growth in the U.S. next year. Executives spoke to analysts in its hometown of Bentonville, Arkansas, explaining that progress has been made to fix the fundamentals, but there is still some runway to go. And the crux of Walmart's plan uses its stores and online business together. The retailer says consumers that shop both in its stores and on its website spend twice as much as those who buy only in store.
We must make sure that we're doing what's necessary to earn customers' business. Growth in comp stores and through e-commerce is a real priority for this company.
While Walmart's online sales are growing rapidly, it's starting from a relatively small base compared to sales in its stores. And growing the digital business has been costly.
When you're building out an online business, you're building a second business. And at some point in time, you're going to start to see those two businesses converge, and you'll be able to shake expenses out of the system. And I think Walmart's in the early stages of that.
Walmart is already the country's largest grocer, and food accounts for more than half of its total sales. By the end of next year, it will double the number of stores offering online grocery ordering with store pickup, a major part of its plan to get new shopper dollars.
If you can offer fresh produce, consumables at the very best prices with a really good experience, whether it be pickup or delivery, then you have a good chance to build a long-standing relationship that you can then leverage to sell the rest of general merchandise.
Walmart isn't the only retailer eyeing grocery as the way to shoppers' loyalty. Amazon is as well, with its recent purchase of Whole Foods.
Groceries is such a small percentage of that is online, so I think it's a category that I think it's ripe for disruption in the space. And who better to do that than Amazon?
Beyond grocery, most analysts and shoppers agree that Walmart has improved both the stores and the website in recent years, but that doesn't mean the work is done, especially as consumers' choices only grow. Amazon continues to reshape retail, and the all-important holiday season is just around the corner. For Nightly Business Report, I'm Courtney Reagan.
The fellow Dow component Procter & Gamble was at the center of the largest proxy fight ever. In one corner, the company and the board. In the other, the activist investor Nelson Peltz. The battle divided company investors, and today it ended just as it began, messy. In response, the stock fell. Sarah Eisen was at P&G headquarters in Cincinnati for the shareholder vote.
Procter & Gamble declaring victory today in the culmination of a months-long, very costly and somewhat ugly proxy fight against one of its top investors, Nelson Peltz of Trian, to keep him off the board. Peltz says the vote, though, was too close to call. The margin, less than 0.4%, and he's going to wait for a final tally before he concedes defeat. Either way, though, he says the message was sent to big companies around the world loud and clear.
There might be arrows in my back temporarily, but we're a pioneer. The fact is, there is no company today that can't be called to task, not one. And heretofore, all of these companies, they were, you couldn't get near them. You know, you could buy something from them if you were private equity, but you couldn't call them on the carpet. That's changed. and that's changed forever.
P&G CEO and Chairman David Taylor had a chance to respond in his message to fellow CEOs when it comes to his playbook in defeating an activist investor.
There's only one solution to this, and that is deliver better results. The message that I've got, the management team, the board, is in what we're focused on. And we've started this process several years ago, is deliver better results. You know, as I talk to other CEOs, and I know they're concerned with this, is that the pace that you have to move in order to stay at the lead in your industry gets increasingly difficult, which is why the changes that we're making to transform this company are so fundamental to the future. And message to me, to the board, to the company is, let's do the right things, do them faster, and do them the right way.
Procter & Gamble is a few years into its transformation. It's trying to adapt to the way that consumers have changed their behavior around what they buy and how they buy it. Also dealing with sluggish economic conditions and the stronger dollar over the last few years, Taylor says he got the vote of confidence he needs to continue that transformation, but he also got the message that he needs to move faster. From Cincinnati, for Nightly Business Report, I'm Sarah Eisen.
The Dow component Pfizer is considering spinning off or selling its consumer health unit. The drug company said it has begun a strategic review of that division that includes Advil and Chapstick, among many others. The unit is one of the largest healthcare businesses of its type in the world, makes up about 6% of Pfizer's total revenue. In response, the stock rose slightly in trading today.
So is it a good thing for investors when a company like Pfizer decides to get back to its roots or refocus on its core business? Chad Morganlander is the portfolio manager at Washington Crossing Advisors, and he joins us now to talk about that. Welcome, Chad. Nice to see you again.
Thanks for having me.
As I understand it, you think it is a good thing when a company refocuses like this on its core business. Why is that?
Well, it's the evolution of a conglomerate that's slowly starting to break off. The management team is focusing their attention on the properties that deliver high returns, and that's what you're seeing with Honeywell, Pfizer, and others that are going to come out in 2017 and as well in 2018. So I believe that overall that this is a positive step for not only Pfizer, but also for the other conglomerates. You know, I was amazed to see that it was only that the consumer healthcare business, Chad, is only like 6% of Pfizer's revenue. What this is really basically, isn't it, a big bet on high-end, high-margin, high-growth pharmaceuticals where you've got pricing power. A chapstick's going to remain 98 cents for a long time. Right. Well, no doubt about that. And now they're going to sell that for a hefty premium. This consumer staple side of the market is really selling at an elevated valuation at this point. They're going to redeploy that capital that they get from that and either buy a early stage suite of healthcare or pharmaceuticals, or they're going to buy back shares with that, or go to capex to actually increase their portfolio. It would also give them the money, would it not, if they have a lot of outstanding debt, and I don't know how much they have, but they could basically write off that debt, pay off that debt, or refinance it at a lower rate. Without a doubt, you're going to continue to see that as well, where you're going to, many of these multinationals are going to sell properties and then pay down their debt burden after, or buy back stock to optimize their balance sheet. But overall, what you're going to see going into 2018 is that many multinationals are going to continue to go through their portfolio, look to sell their properties or spin them off. And you have to keep in mind that a lot of private equity firms have a tremendous amount of funding capability to go buy these at a real quick, Chad, bottom line me. If I own or am interested in a company that is slimming down this way, is it a good sign, yes or no? I would say it's a great sign. We would be buying Honeywell. We do own Honeywell. We own Pfizer. We own Wal-Mart. We would continue to be buyers of these three companies. Excellent. Thank you, Chad. Appreciate it. Thank you. Chad Morganlander with Washington Crossing Advisors. Ty? On Wall Street today, Sue, Wal-Mart and Pfizer, just talking about them, gave the stock market a lift. The Dow did close at the record we mentioned earlier, closing in now on 23,000. The blue chip Dow index up 69 points to 22,830. The NASDAQ added 7.
and the S&P 500 gained nearly 6. As the stock market has moved to new highs, there are some stocks that are attracting fresh interest. Bob Bazzani explains.
We've seen a record rally in all the major indices, and investors have even turned their interest to some very strange underperforming parts of the market. The latest example are micro-cap stocks. That's right. The iShares Microcap ETF, IWC is the symbol. It's been around for a decade, but it's not attracted any interest until recently, and with good reason. It only owns the smallest of publicly traded companies, the bottom 1,000 of the small cap Russell 2000 index, and the remaining 500 or so stocks that are even smaller than those in the Russell 2000. We're talking companies with typical market caps between $50 million and $300 million. These microcaps have outperformed the broader market recently, and they hit historic highs as well. What's going on? We have a confluence of rising rates and the tax cut trade. All these things are positive for not only the small cap stocks, but especially for micro-cap stocks. A few other factors are helping out. First, the market's lifting across the board, so many micro-caps have a good chance of graduating into small-cap indexes like the Russell 2000. That would drive wider ownership. Second, sector exposure. The IWC is 25% weighted to financials and 25% weighted to healthcare. Those are very hot spaces, so I can see momentum traders adding this to their broader stake just to get a little bit of edge in performance. Finally, there's this whole ETF wrapper thing. By having an ETF, you allow it to be traded on platforms provided by brokerage firms. It's one of the only relatively safe ways to get into these darker, less exposed corners of the market, like microcaps. For Nightly Business Report, I'm Bob Bassani at the New York Stock Exchange.
Still ahead, flying under the radar. You may not know its name, but this chip maker is definitely making a name for itself. The deadly fires racing across America's California wine country have burned hotels and some wineries, potentially hitting the multi-billion-dollar wine industry hard. Aditi Roy is in Santa Rosa tonight.
The flames were fast and furious, springing from nearly 12.5 wildfires and ravaging more than 100,000 acres in 9 California counties, leaving behind a path of destruction. At least 15 people died and 20,000 had to flee.
I mean, there's ashes falling down everywhere.
Among the evacuated, roommates Shelby McClintock and Amanda Bowen. They left their home Sunday night when the flames got too close for their comfort.
I was woken up at 2 in the morning and the hills were just glowing red. Our housemates were freaking out. I already knew from the beginning, just from like the coloration in the sky, that I was like, I'm packing a bag.
They've been living in this shelter since. The firestorm leveling entire neighborhoods like this one in Santa Rosa, California. Businesses are affected too, like this Kmart burned to the ground. This Hilton Hotel in Santa Rosa also decimated. Sonoma and Napa Valley wineries, which play a critical role in local tourism, have been impacted as well. Among the wineries destroyed by the fire, Paradise Ridge in Sonoma County, and Signorello Estate and White Rock Vineyards in Napa. The wineries that have been damaged include Stag's Leap, William Hill, Chimney Rock, and Dariush. As officials survey the damage, McClintock and Bowen are just worried about what they will find when they get home.
I've lived here my whole life, and you never really think about stuff like this happening until it happens to you.
It does not feel real at all. I mean, we can't even see the sky right now.
As they brace to find out the damage to their home, the Napa Valley Vintners Association reports that 90% of this year's harvest has already been completed and that it's too early to tell the impact of the wildfires on next season. For Nightly Business Report, I'm Aditi Roy, Santa Rosa, California.
American and United see clearer skies ahead. That's where we begin tonight's market focus. Despite canceling thousands of flights due to hurricanes, American Airlines raised its guidance, saying unit revenue could grow as much as 1.5% this quarter. United said it expects to report an improved profit margin thanks to lower fuel costs, and also noted that revenue per passenger mile wouldn't fall as much as initially expected. Shares of American rose nearly 5% to 53.03, while United shares were more than 4% higher to 67.72. Amazon is reportedly beefing up its delivery services even more. CNBC says the e-commerce giant is interested in partnering with Frame. That's a company that develops smart license plate frames, which would allow packages to be delivered right to customers' car trunks. CNBC said Amazon is also developing a smart doorbell that gives delivery drivers one-time access to a customer's home. Amazon shares fell fractionally to $987.20. And after the Bell IT security firm Barracuda Networks said an increase in subscribers helped revenue rise at a faster clip than analysts were expecting. Gross profit also rose, but higher marketing costs cut into those results. Shares initially fell in the extended hour session, but finished the regular day up a penny to $25.74.
The pharmacy benefits manager Express Scripts will buy privately held medical benefits company Evacor for more than $3.5 billion. Express said the deal will help it better manage patient costs. Shares of Express Scripts off nearly 2% to $58.18. And after the bell, the memory chip maker Micron Technology said it plans to offer $1 billion worth of common shares. Micron said it will use the proceeds to trim debt. Shares initially traded lower after hours, but finished the regular session up almost 2.5% at $41.98. And the power management company Eaton said it expects net income and operating earnings per share this quarter to take a 3-cent hit. That's following those recent hurricanes. The company said its facilities in Puerto Rico suffered damage, but are now back in operation. Shares were up 30 cents to $77.98.
Shares of Nvidia hit an all-time high. The stock isn't a household name, but it is making a name for itself on Wall Street. The chipmaker today saying it built a powerful new computer that can turn semi-autonomous cars into fully driverless vehicles, a technology that some are calling a game changer. That sent its shares up nearly 2% to a record. Over the past year, the stock has been making impressive gains in a very competitive industry, in part because of Nvidia's ability to transform itself from a video game chip maker to a leader in artificial intelligence.
What we thought was going to be science fiction for years to come is becoming reality as we speak.
NVIDIA's latest advance, called Pegasus, speeds up its Drive PX platform, already used by the likes of Toyota, Audi, Tesla, Baidu, and European truck supplier ZF in the race to develop a fully autonomous vehicle. NVIDIA is used to driving leaps in technology. From its start in 1993, NVIDIA's graphics processing units, or GPUs, aimed to make video games ever more realistic. Microsoft's Xbox, Sony's PlayStation, and Nintendo use them, and NVIDIA's technology is used in smartphones, tablets, and these days, your car's infotainment system. Gaming still accounts for nearly 60% of its revenue, more than $4.8 billion. But now, data center technology is its fastest growing segment, used in huge build-outs by the likes of Amazon, Facebook, Microsoft, Baidu, Alibaba, and Tencent. Data is what makes artificial intelligence intelligent. The more data used, the more a computer can learn, allowing it to make computers better and more efficient. It can help computers find better answers to our search queries, better advice for doctors, and better results for NVIDIA's autonomous driving platform.
This technique allows software to write software, allows computers to learn from experience and data.
Here to talk more about NVIDIA, its growth story, and where it may go from here is Stacy Rasgon. He's semiconductor analyst at Bernstein Research. Stacy, thanks for joining us. Good to have you with us tonight. I think a lot of investors are very concerned about coming to a party late. This has been a heck of a party. The company is firing on all chips, if you will. But is there still room to run?
Yeah, I think there's probably still room to run. This is a company that is exposed to virtually every high growth and attractive area in the semiconductor market today, whether it's artificial intelligence, data center, autonomous driving, and frankly, even gaming is a very good market. They're exposed to it all.
How much in front of everybody else do you think Nvidia is?
You know, they are in front by a wide margin. They have been investing in this space for many, many years. Many of their other competitors are actually in the process of playing catch up. They've been developing not just the hardware, but also the software and the development environment that goes along with it to enable the programmers to actually write to the hardware itself. And they've been developing this. It's forming an ecosystem. They've been doing this for close to 10 years. Because it's creating almost a de facto standard in many of these markets today. Again, their competitors are catching up, and in many cases, they're going to be coming up against a barrier that this has created for Nvidia.
In one of your recent reports, you say you think it is possible that the stock might take a little bit of a breather after its run, but you give it more room to run eventually. Why might it take a pause that refreshes and then move? And tell us where you've moved your price target recently.
Well, I mean, anytime a stock is up, 80 to 100% in less than a year, it's likely to take a pause. And if you go back to their last earnings report, the stock did take a little bit of a breather momentarily, only because the data center business, it grew tremendously year over year, but expectations were maybe for even a little bit more. I think many investors, though, want to own the stock. Many of them are waiting for pullbacks, and frankly, that little bit of a dip didn't last very long. It got bought as investors came in.
So what are you watching for that might trip up the company or might signal that there's someone else in that particular space that's gaining on them?
Sure. I mean, there are a number of competitors today, both chip companies as well as cloud vendors, companies like Google, for example. But I think what people need to be aware of is we're almost in the first at-bat of the first inning right now. My biggest worry today is not really so much competition. It's more the pace of market adoption. When you have an exponential market growing when you're right at the beginning, people tend to do two things. Number one, they tend to overestimate how quickly we'll get to the knee of that curve. Once we get to the knee, they tend to underestimate how quickly the ramp will be. I want to get to the knee of the curve as quickly as possible. And frankly, I believe what everybody else is doing in the space is actually accelerating adoption. I think that's a good thing.
What a great story this company and you have to tell. Stacey, thanks very much. Stacey Razgon with Bernstein Research.
You. And coming up, is the corporate jet business ready for takeoff?
These are the newest wings for the high flyers of the corporate world. But are companies ready to buy even more business jets? I'm Phil LeBeau. That story coming up on Nightly Business Report.
Here's a look at what to watch for tomorrow. We'll get the minutes of the last Federal Reserve meeting. Investors will be looking for clues on the timing of the next interest rate move. Delta Airlines, the second largest carrier in the U.S., will report its earnings. And the fourth round of NAFTA negotiations will take place in Washington. That's what to watch for on Wednesday.
The NFL Commissioner Roger Goodell says the league believes players should stand during the national anthem and that team owners will discuss a plan when they meet next week. In a memo released today, he stopped short of saying that the NFL would require players to stand. It's been reported that some sponsors feel the national anthem controversy is putting them in a tough spot.
While many sectors of the economy may have rebounded in recent years to pre-recession levels, the corporate jet market has been very slow to take off. But executives in that industry say a big liftoff could be coming. Phil LeBeau reports from the National Business Aviation Association convention in Henderson, Nevada.
For high flyers in the corporate world, this is heaven. The latest business jets, from the smallest to the largest, on display for buyers who want new wings.
We're seeing a good uptick in the amount of people that are interested with respect to the different products that we're investing in. We've got a good, long lead list of individuals that are coming out to the show that are going to look at some of the new products that we've been able to demonstrate.
These jets may be spectacular, but business jet sales have not been as impressive. In fact, they've failed to climb back to the lofty levels seen before the recession. And this year, deliveries are expected to edge lower. With stock prices and corporate profits near record highs, why have corporate jet sales failed to soar? Industry leaders say potential buyers are waiting for the U.S. economy's growth to kick into a higher gear.
What we're seeing is kind of 1% and 2% growth year over year. And I think what we're expecting, particularly as the economy begins to grow over 3%, that's usually a key area where over 3% growth leads to some pretty strong growth in the business aviation community.
Jet makers believe it's not just companies primed to buy, but also fractional ownership programs. And the trend of the ultra-wealthy needing to fly further, faster, is creating a market for higher-end jets like Embraer's top-of-the-line Lineage model.
Lineage is our ultra-large aircraft, $55 million. It's considered the home away from home. It allows for our customers to have a bespoke interior experience just like they would at their house.
Adding to the optimism of the business jet market is a global economy where nearly every region of the world is experiencing growth that many hope will lead to greater demand for these planes. Phil LeBeau, Nightly Business Report, Henderson, Nevada.
And that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody, and we'll see you here tomorrow.